Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know first Waymo's driverless cars hit 65 miles per hour on US freeways, commercializing paid Robotaxi rides ahead of Tesla. We'll analyze why this methodical launch is a turning point and how it affects the competitive race for full autonomy. Second, a UK retailer will cut 2/3 of its workforce in 3 years, blaming AI and government policy pressures. We'll explore how this rapid automation could transform European retail jobs and what it means for customer service quality. Third code, Metal raises $36.5 million for AI that translates legacy code, landing major US military and industrial contracts. We'll examine how this approach solves technical debt for mission-critical systems and challenges the AI code generation trend. Fourth, Tencent's international gaming revenue soars 43% with a hybrid AI, now challenging US cloud giants in Europe. We'll explore how its data localization strategy could transform European cloud competition and impact US market leaders. Fifth, Bezos-backed Arrive launches a secondary market for its $100 real estate shares, creating a stock market for housing. We'll analyze why this new liquidity is a turning point and how it could accelerate the financialization of the housing market. The most unexpected news in the tech world today has to be this. A self-driving car is now taking paying customers onto major US freeways at 65 miles per hour. This isn't a test, this is live. Alphabet's Waymo has just flipped the switch, launching fully autonomous paid robotaxi rides on the freeways of San Francisco, Los Angeles, and Phoenix. After more than a decade of testing, the company is finally letting its cars navigate high-speed traffic with public riders in the back, no human driver required. So a natural question pops up, right? What happens if a police car needs to pull one of these over? Well, Waymo has thought of that. They've developed detailed law enforcement interaction protocols. The cars are designed to detect and yield to emergency vehicles, and there are specific procedures for officers to safely stop the vehicle. Waymo has even trained over 18,000 first responders across more than 75 agencies on exactly how to interact with their cars, and they have a 24-hour support line for real-time assistance. According to Waymo's co-CEO, this was the final boss of self-driving. His words, "Freeway driving is one of those things that's very easy to learn, but very hard to master when we're talking about full autonomy without a human driver as a backup and at scale. It took time to do it properly. This is where the situation takes a more complex turn. Mastering the freeway is so difficult because of the sheer speed and complexity. At 65 miles per hour, the car's sensors and software have to predict the actions of other vehicles much further in advance. Waymo's technology is key here. Their cars use a combination of sensors, primarily LiDAR and high-resolution cameras. LiDAR is like radar, but with lasers, and it's incredibly precise at measuring distance, even in the dark. In fact, studies show LiDAR has a 95% object detection accuracy in low light, compared to just 75% for cameras. But cameras are better at identifying what things are, like reading road signs or distinguishing between a police car and a delivery truck. The real magic is fusing all that data together in a fraction of a second to make a safe decision. And this isn't just a technical challenge, it's a psychological one. You know, imagine being a passenger. To build trust, Waymo has designed the car's driving personality and its in-car screens to constantly communicate what the car is seeing and what it plans to do next. You can see the other cars, pedestrians, and traffic lights on the screen just as the car sees them. This transparency is designed to reduce anxiety. And for that extra peace of mind, there's an emergency button that lets the passenger tell the car to pull over. And that puts one major competitor directly in the spotlight. While Tesla customers can hail a ride to the airport through its Robotaxi app, the name is not precisely descriptive. Those cars still have human drivers behind the wheel due to a mix of technical limits and permit requirements. Waymo is now operating without that human backup on the highway. When we place Waymo's methodical, geo-fenced approach alongside Tesla's vision-only system, the stark difference in strategy becomes clear. Waymo meticulously maps every road in a limited area and equips its cars with a rich sensor suite of LiDAR, radar, and cameras. This is safer and more reliable, but slower to expand. Tesla, on the other hand, is pursuing a system using just cameras and AI, deploying it to its entire consumer fleet to gather massive amounts of data. It's a faster, potentially more scalable approach. but it has yet to achieve the fully driverless capability that Waymo is now commercializing on highways. This is not a small-scale experiment. The company is now covering about 260 square miles of Silicon Valley alone, including a new route to the San Jose Mineta International Airport. This marks its second major airport. After Phoenix, Sky Harbor became its single most popular destination in the entire metro area. With plans already announced for Miami, San Diego, and Washington, D.C., plus testing in New York and Tokyo, the race for autonomous dominance is accelerating. After years of promises across the industry, Waymo is making a clear statement. It's not just talking about the future of transportation. In 3 major American cities, it's now taking payments for it at full freeway speed. We were just talking about the advanced AI powering self-driving cars, but that same force is now threatening to dramatically reshape the workforce in Europe. The boss of one of the UK's largest online retailers just predicted his workforce will be slashed by 2/3 within the next 3 years. Nick Glynn, the head of Buy It Direct, which owns major brands like Appliances Direct, delivered a stark forecast. The company employs over 800 people, and Glynn estimates more than 500 of those jobs are set to disappear. The reason? A massive shift to artificial intelligence and automation. To put that in perspective, we're talking about 2/3 of a company's staff gone in just 3 years. Is that even possible? Well, to pull this off, the company would need to make a massive capital investment. For the warehouse alone, that means autonomous mobile robots and automated storage and retrieval systems. Research shows that even a basic automation setup for a mid-sized facility can cost anywhere from $500,000 to over $2.5 million. And while the return on that investment can be quick, leaders in this space, like Amazon, have taken many years to gradually build up their robotic workforce. So a 3-year timeline is incredibly aggressive. In his own words, the future for hiring people in the UK is, quote, very bleak for his business. Glynn said a combination of AI in the office and robotic automation in the warehouse will allow the company to maintain the same revenue with 2/3 fewer people. But the story gets more complicated. Glynn claims that government tax decisions, including increases in the national living wage and national insurance, have accelerated the direction of travel. However, if you zoom out, you'll see another layer to this story. Recent policy changes have added an estimated £5 billion to the annual wage bill for the entire UK retail sector. The British Retail Consortium has even warned that these rising costs could result in the loss of 160,000 part-time retail jobs over the next 3 years. So while AI was always the destination, these policies are acting like a powerful accelerator. And it's not just about robots. The company is actively outsourcing senior positions outside of the UK. Glynn confirmed they now have accountants, managers, traders, and senior IT managers all working abroad. He called the experiment a success, adding that in many cases, overseas workers are, quote, just as qualified, more motivated in some ways than UK workers because there's less protection for people. Now, get this, for decades, we believed senior white-collar jobs were safe from this kind of outsourcing. What's changed is AI. We're not just talking about video calls. AI-powered platforms like Slack and Microsoft, teams can now do automated transcriptions and intelligent scheduling, while project management tools like Trello can use AI to automatically assign tasks and monitor team performance. This makes managing a high-skilled, global team easier than ever, effectively erasing the geographic advantages of a local workforce. This isn't happening in a vacuum. Amazon recently announced its own major job cuts, citing a need to be more leanly organised to seize opportunities in AI. The message from the Buy It Direct CEO is clear. A combination of AI, automation, and a strategic pivot to global talent is not a distant future. It's a 3-year plan that is already in motion. But here's the one thing that isn't mentioned in this entire efficiency-driven plan: the customer. The focus is entirely on cost cutting. This decision brings both potential savings and comes with inherent risks to the customer experience. Research shows that nearly 80% of consumers demand a personalized experience to stay loyal to a brand, and 70% are willing to leave after just 2 negative experiences. The big question is whether AI, chatbots, and automated systems can truly replace the nuanced problem-solving of an experienced human, or if this race for efficiency will lead to a collapse in service quality that ultimately drives customers away. Speaking of AI's impact on business, it's not always about replacing workers. Our next story is about a company using it to solve a problem that has plagued engineers for decades: technical debt. An AI CEO just drew a battle line in the sand against the biggest trend in coding. While companies like Anthropic push vibe coding using text prompts to generate software, CodeMetal's CEO Peter Morales says that's, quote, not where most companies spend their time. And he's got a $36.5 million war chest to prove it. CodeMetal just secured a massive $36.5 million investment led by Excel Partners, the legendary firm that backed Facebook and Dropbox. But this isn't just another AI coding tool. Instead of generating new ideas, their technology takes finished code and automatically translates it to run on any other platform. Believe it or not, this is the holy grail for that massive problem called technical debt. For decades, companies have tried to automatically translate old legacy code, think COBOL, from the 70s into modern languages like Java. Most of these projects failed, producing messy, unmaintainable results. What makes this different is the AI. Early studies on AI-driven modernization are showing up to 93% accuracy in code transformation, which blows older methods out of the water. This allows a feature built for a new sports car's NVIDIA chip to instantly work in an old minivan. The real-world application here is enormous, especially for what are called embedded systems. These aren't like your laptop. They have very specific constraints like low memory, real-time processing needs, and hardware-specific instructions. The software world for these devices is incredibly fragmented. CodeMetal's AI is designed to navigate that messy landscape, automating the translation and optimization that used to take teams of specialized engineers months or even years to complete. Morales is directly challenging the entire vibe coding movement, stating his focus is on production-ready code with strong guarantees of accuracy. To do that, CodeMetal uses what computer scientists call formal methods, not just large language models, to ensure every translation is perfect. So, what are these formal methods? Well, they're the core of CodeMetal's advantage. Instead of just guessing what the code should look like, formal methods use mathematical logic to create a provably correct blueprint of the software's behavior. Think of it less like an artist painting a picture and more like an engineer following a precise schematic. It provides a mathematical guarantee of correctness, which is absolutely critical for safety-focused industries where software failure is not an option. But that's not the whole picture. The real turning point is that CodeMetal has already signed contracts worth tens of millions of dollars with commercial and public sector giants, including the US, Air Force, L, 3 Harris, and Raytheon. Their work with the defense sector, for instance, shows just how critical this technology is. They are solving a huge problem for the military, modernizing ancient code on aging hardware and crucially making sure that systems built by different defense contractors can actually talk to each other. Their platform is so promising that the Department of Defense's own Chief Digital and Artificial Intelligence Office has given it an awardable status, signaling its massive potential for mission-critical operations. The lead investor calls it the fastest growing company in his firm's early stage portfolio and says the market opportunity is practically uncapped. While the world obsesses over AI that can dream up new software, CodeMetal is quietly dominating the far more critical business of making it actually work everywhere, and it has the military and industrial contracts to prove it. While CodeMetal is tackling deep tech problems for industry, one of the world's biggest consumer tech giants is using AI to fuel explosive growth in a completely different area. Let's start with a single statistic that might just change your entire perspective on this company. Tech giant Tencent just reported its international gaming business has exploded, soaring a staggering 43% in just 1 year. So, how did they pull that off? Actually, Tencent has a unique playbook for global growth. When they acquire a studio, like Riot Games, the creators of League of Legends, they use a decentralized approach. They provide the money and resources, but let the studio keep its creative independence and operational autonomy. This is a stark contrast to competitors who often struggle with messy integrations. It's a strategy of empowerment, not control, and it's clearly working. So what's the secret weapon behind this global blitz? The CEO, Ma Huateng, just went on the record confirming their massive investments in AI are paying off, supercharging everything from game engagement to ad targeting. What really brought this to a head was their clever hybrid AI strategy. They have their own powerful in-house model called Hunyuan, which is outperforming competitors on key benchmarks, but they're also integrating other models like DeepSeek. This is interesting because it shows they're not dogmatic. They're using a best tool for the job approach. Combining the strengths of multiple A is to create the best possible products. It's a flexible and pragmatic strategy that gives them a serious edge. This isn't just theory. Hit titles like Valorant Mobile have become what Tencent calls China's most successful mobile game launch year to date. If that was just the appetizer, the main course is just being served. It's not just about gaming. The company is using its foundational AI model, Han Yuan, to enhance everything from coding to video production, fueling a 15% total revenue surge to over $27 billion in a single quarter, crushing analyst expectations. From a business perspective, the numbers are compelling. The company reports that this AI integration has boosted their R&D efficiency by a massive 20%. AI is now assisting in half of all new code generation, cutting coding time by 40%. This allows them to innovate faster while actually reducing capital spending, which is down 24% year over year. They're spending smarter, not just bigger, but the company is now taking this AI-powered momentum straight into Europe, launching a direct challenge to the biggest names in cloud computing, Amazon Web Services, Google Cloud, and Microsoft Azure. This move is particularly bold because entering the European market is incredibly difficult, especially with all the tech tensions and Europe's push for digital sovereignty. So how is Tencent planning to compete? Their strategy to break in hinges on trust and compliance. They are building data centers physically located inside Europe to ensure all European user data stays in Europe, complying with strict GDPR privacy laws. By committing to data localization, they're directly addressing the biggest concerns European governments and businesses have about foreign tech. This all begs the question, what's the real endgame here? It's a full-scale push for global dominance powered by AI, and the market is rewarding them for it. Tencent stock is up an incredible 56.7% this year alone. Tencent stock is soaring. And speaking of big money moves, our final story looks at how tech is trying to create a brand new stock market for houses. A company backed by Jeff Bezos and Salesforce CEO Mark Benioff just launched what one investor calls a stock market for real estate. The company has arrived, and it lets you buy and sell shares of individual rental homes for as little as $100. For years, this kind of direct real estate investing was mostly for the wealthy. But the key was Arrive spending over a year working with the SEC to qualify its offerings under a framework called Regulation A+. This allows them to offer these shares to everyday non-accredited investors, not just millionaires. It's a complex legal process that creates a huge barrier for any potential competitors. But they just dropped a bombshell, a new secondary market where investors can trade their shares of these homes in minutes, bringing stock market style liquidity to an industry famous for being slow. The word liquidity is a game changer here, but it's not as simple as it sounds. Creating a truly liquid market for shares in a single specific house is incredibly difficult. The big question is, who will buy your shares if that specific home's local market takes a downturn? While this new trading platform is a massive step forward, the challenge of ensuring you can always sell your shares instantly, what some call the liquidity paradox, is something the entire industry is still trying to solve. And the response has been explosive. In just the first 3 weeks, investors have already submitted 57,000 buy and sell orders on the new platform. This all comes from a new $27 million funding round, bringing their total to over $61 million. The lead investor, Ali Partovi of Neo, didn't hold back, saying, "The Arrive team is cracked, and I love the audacity of their vision, a stock market for real estate." Other backers include the CEO of Uber and the CEO of Match Group. The stated goal, to digitize and democratize access to America's $50 trillion residential real estate market. And while democratizing access sounds great for small investors, it also raises a tough question. Does this accelerate the financialization of housing? By turning more single-family homes into assets traded like stocks, it could increase competition for first-time home buyers and potentially drive up local prices and rents, which is a major debate happening right now. And it's not just a vision. Arrive has already pulled in over $330 million from more than 850,000 investors across the country, doubling its property count each year. So how are they picking all these properties so successfully? You might remember when Zillow tried to use a complex algorithm for buying and selling homes, and it failed spectacularly. Interestingly enough, Arrive takes a different approach. Instead of relying only on algorithms, their investment team manually selects properties in markets with strong population and job growth, focusing on newer homes. It's a reminder that in real estate, human expertise still seems to beat a pure computer model. This radical new platform is launching at a moment when traditional home buying has stalled and investors are making up the highest share of home buyers on record. To protect against market weakness, the company has made a critical move. The majority of its properties are now owned with 100% equity, ditching long-term debt and showing they are preparing for a new era of real estate. This no-debt strategy is a very conservative and defensive move, protecting the company and its investors from the risks of rising interest rates, but it's only one part of their business model. Arrive makes its money from a one-time sourcing fee when they buy a property and a quarterly asset management fee. The real stress test will be whether this fee-based model can remain profitable during a prolonged housing downturn when prices and rents might go flat.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.